What if I told you that one investor earned over $1 billion in a single day? Not by building a company, not by launching a product, but by challenging a national currency policy. No drama, no exaggeration, just timing, understanding, and conviction. His name was George Soros, and one decision in 1992 made him a permanent figure in financial history. Why this story still matters. George Soros is one of the most influential figures in modern finance. Over decades, his career has been studied in universities, discussed on Wall Street, debated in economic circles. Some see him as a brilliant investor. Others focus on the scale of his influence. But regardless of opinion, one thing is clear. His ideas changed how people think about markets. This is not a story about politics. This is not investment advice. This is a historical story about how financial systems react under pressure. George Soros was born in 1930 in Hungary. His childhood took place during a time of war, economic instability, rapid political change. Like many families in Europe at the time, survival required adaptability. Years later, Soros would reflect that these experiences taught him an important lesson. Economic and social systems are not permanent. They can change quickly. This early exposure to uncertainty shaped how he viewed the world. After World War II, Soros moved to England. He worked small jobs to support himself while studying philosophy. There, he was influenced by the ideas of philosopher Karl Popper. One idea stood out. Human understanding is imperfect, and decisions are often based on incomplete information. Soros began to apply this thinking to markets. He believed markets were not perfectly logical systems, but reflections of human behavior. Soros developed a framework known as reflexivity. In simple language, people's beliefs influence market prices. Market prices then influence people's beliefs. This feedback loop can push prices too high or too low. Instead of assuming markets were always balanced, Soros focused on how expectations can distort reality. This approach would later define his most famous decisions. In the early 1990s, the United Kingdom was part of a European currency system designed to keep exchange rates stable. However, economic growth was slowing. Interest rates were under pressure. Maintaining the currency's value became increasingly difficult. While public statements expressed confidence, some investors believed the policy was unsustainable. George Soros was one of them. He took a position that would benefit if the British pound declined in value. This was not a statement against a country. It was an assessment of economic conditions and policy limits. Eventually, the UK government adjusted its approach. The pound fell. As a result of this sequence of events, Soros's fund recorded profits estimated at over $1 billion. The moment became widely known in financial history. After 1992, Soros became a global reference point in finance. His career sparked discussion around questions like, how much influence should large investors have? How do markets respond to policy pressure? Can financial systems correct themselves? Soros himself often emphasized, markets reveal weaknesses, they do not create them. These discussions continue today in academic and financial institutions. One of Soros's most well-known statements is, it's not whether you're right or wrong, but how quickly you adjust. Unlike many investors, he focused on risk control, flexibility, willingness to change course. This mindset, more than any single trade, defined his long-term success. This story offers broader lessons. Financial systems are influenced by human behavior. Confidence does not always equal stability. Adaptability matters more than certainty. Understanding markets requires more than numbers. It requires understanding people. George Soros did not try to predict the future. He focused on recognizing when expectations and reality were out of balance. That approach left a lasting mark on financial history. If you found this documentary useful, like the video, subscribe for more finance history stories, and share your thoughts in the comments. Because the most important lessons in finance often come from understanding how systems respond under stress.